Welcome back to The Explainer, everyone. So, if you've been keeping an eye on the markets lately, you already know that, well, sometimes a single weekend can just completely rewrite the rules of the game, and honestly probably ruin a few traders' weekends in the process. We're diving straight into the dramatic, completely unexpected market shifts that completely overturned all our previous forecasts over the weekend of July 27th, 2026. It's the kind of whiplash that catches almost everyone off guard. So, we're going to unpack exactly what happened, why it happened, and what it all means for two of the world's most critical assets right now, oil and gold.
Let's think about the setup here. When traders logged off on Friday, the narrative was, practically set in stone. We had clear expectations, established trends, a geopolitical landscape pointing in one very definitive direction. But then, Monday morning rolls around, and it brings a complete 180-degree turn. It's wild. It perfectly highlights how quickly the financial landscape can just flip on a dime when geopolitical tides turn, instantly repricing assets across the board and catching the whole consensus totally flat-footed. The reversal we saw was immediate and, frankly, violent. Look at this. Crude oil WTI had been enjoying these relatively stable, elevated trading ranges right up until the Friday bell, and then, bam, we wake up to a sheer, almost vertical cliff face right at the Monday open. I mean, this isn't just your routine dip or a minor fluctuation. This is a sudden, steep dive that immediately set off alarm bells and forced trading desks everywhere to just frantically reassess their positions. To put a very specific number on that massive shift, we're now anchoring at roughly $82 a barrel. WTI transitioned abruptly from this remarkably strong upward trend, where honestly buying felt inevitable, straight into severe selling pressure. Hitting that 82 mark, yeah, that signifies a total structural and psychological shift in the market's momentum. Let's put that in perspective. Just a few days ago, WTI touched a peak of $93.05 with the bulls in complete control. Now, we're staring at a plunge down to that $82 level. I mean, that is a massive, massive spread for a commodity as heavily traded and highly liquid as oil. A drop like that doesn't just happen in a vacuum, right? So, what exactly pulled the floor out from under it? Well, the answer lies in a rapid geopolitical de-escalation. See, last week's primary bullish driver was the intense risk of a US-Iran military clash at the Strait of Hormuz. But over the weekend, those tensions suddenly cooled off. Reports came out indicating both sides had paused their escalation. Because that worst-case scenario, which would mean a massive physical disruption of global oil supply, was avoided, the market had to instantly reprice. It's actually incredible to see how fast market sentiment shifts from intense fear to just rapidly cashing out. Traders holding those long positions realized the immediate threat to supply was gone, and that triggered massive, aggressive profit-taking. Everyone rushed for the exits at once, and the price plummeted.
And because of that massive sell-off, oil is now locked in a really harsh correction phase. The short-term advantage has shifted entirely over to the sellers, the bears. After reacting to that $93.5 supply zone, the path for oil to just keep rising is effectively blocked right now. The momentum is purely downward, which is forcing anyone still holding long to seriously reconsider their whole game plan.
But okay, here is where the story gets really fascinating. Because while oil went from a strong upward trajectory straight into a brick wall of selling pressure, gold did the exact opposite. Think about that. Two massive global commodities moving in entirely different structural directions, all based on the exact same weekend news cycle.
And that brings us to a genuine market paradox. Traditionally, as you know, gold is the ultimate safe haven asset. Investors flock to it when geopolitical tensions rise, and they sell it off when those tensions cool. So the question is, if the US-Iran war risks at the Strait of Hormuz are cooling down, shouldn't safe haven gold be dropping right alongside oil? Logically, yeah, it should. But as we all know, markets aren't always perfectly logical. They are complex, interconnected ecosystems. Gold completely defied that traditional safe haven logic here. Instead of falling, it actually opened with a massive gap up, trading robustly around $4,095 per ounce. It went from being heavily squeezed downward last week to suddenly launching higher and testing major resistance levels today. No way anyone predicted that move perfectly.
So to really understand why this happened, we have to look past the geopolitics and dig into the underlying mechanics. We call this the macro ripple effect, and here is exactly how this chain reaction played out. Step 1, oil prices crashed. Okay, step 2, because energy costs are such a massive driver of headline inflation, cheaper oil means overall inflation pressures start to ease up. Step 3, easing inflation makes the market believe the Federal Reserve doesn't need to be as aggressive with interest rates, and that assumption directly caused the US dollar index to weaken by about 0.3% early in the session. Which brings us to step 4, because gold is priced in US dollars, a weaker dollar makes gold relatively cheaper for global buyers, causing its price to absolutely spike. It's like a giant puzzle coming together.
Plus, there's another very human element to this rally, anchored right on a massive psychological floor, $4,000. Last week, when gold was facing all that downward pressure, it dipped down to test this exact level. And rather than seeing this as a sign of critical weakness, savvy investors saw it as a prime bargain hunting opportunity. This is where technical setups and macro events just collide beautifully. When the macro ripple effect kicked in and weakened the dollar, this pre-existing built-in buying pressure at the $4,000 mark acted like literal rocket fuel for the current rally.
But despite this sudden surge in price, the underlying sentiment isn't just reckless optimism. Actually, the fear and greed index for gold is sitting at a very cautious 47. That is strictly neutral territory. The market is essentially holding its breath right now. Traders aren't giving in to extreme greed or panic. They're sitting on the sidelines, waiting for something else to confirm whether this rally is just a temporary blip or the start of a sustainable new trend.
That embedded caution is exactly why the $4,100 resistance zone is so absolutely crucial right now. The bulls might have short-term control of gold, sure, but they are quickly approaching a highly sensitive ceiling. Because the broader market is feeling so cautious, it's highly likely that a lot of funds will view $4,100 as the perfect strategic place to just take some short-term profits. They're going to want to cash out and secure their gains before the next major economic catalyst has a chance to flip the board all over again.
So what is everybody waiting for? Well, the answer is sitting right there on the calendar. Fed Chair Kevin Warsh's meeting on July 30th. This upcoming meeting ties our entire macro narrative together. The oil crash lowered inflation expectations, which weakened the dollar, which in turn boosted gold. But guys, that entire chain reaction is built on one massive assumption. The assumption that the Federal Reserve will now pivot and become less hawkish. But an assumption is just an assumption until the Fed actually speaks.
Which leaves us with a final, absolutely critical question. Will Fed Chair Kevin Warsh and the committee actually validate the market's newfound optimism this Wednesday, confirming that inflation pressures really are easing? Or will they strike a hawkish tone, completely shattering this narrative and triggering yet another massive whiplash reversal across both oil and gold? The market has placed its bets, but we won't know the true outcome until Wednesday. It is going to be a very tense wait. Keep a close eye on those charts, and thank you so much for joining this explainer.